You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Thank you for tuning in to the Generational Wealth Through Commercial Real Estate show. It's your host, Will Smith, and I'm here today with Larry Pendleton. But before we get into today's show, if you're watching this show for the first time, do me a favor, go ahead and hit the subscribe button. You know, I want to keep growing this show. And if you've been watching this for some time and you haven't left me a review, go ahead and leave me a review. These reviews are how I keep bringing on rock star guests like I have today. All right, housekeeping is out of the way. Today's guest is Larry Pendleton. He's a real estate investor and CPA with a passion for adding value to fellow investors through tax consulting and accounting services. Along with PC Financial Services, he is also the director of finance for a real estate investing firm, Rize Equity Holdings. Larry, man, thanks for coming on the show today, man. I'm excited to have you here.
Thanks, Billy. Happy to be on. Very grateful.
Absolutely, man. So, you know, give us a rundown on who you are and how you got to where you're at right now, because I know you're doing the CPA, work, and you're also an investor. So, man, we just want to hear your story on how you got to where you're at right now.
Yeah, so born and raised out of Norfolk, Virginia, so southeastern Virginia, Hampton Roads, Virginia Beach, if whoever's familiar with the area.
Yep.
Grew up in a single family household with my dad, and just kind of noticed he always kind of like working long hours, and it never seems, I mean, we had enough, like I said, we were never in need of anything, but just getting an understanding like how much like just the whole cash flow aspect of things and whatnot there, and I kind of got interested in banking from that standpoint. Didn't really grasp the concept of accounting growing up until high school, and as I told you, it was really a crush on a high school teacher that was that in accounting. So didn't work out with her, but like I said, I got my itch into accounting, and
right.
I guess for those that kind of keep up with like Rich Dad Poor Dad, kind of like follow that track of do good in school, go to college, get a good job, and that's what I did, just kind of not knowing that. I mean, that may have not been the best route for financial freedom from that standpoint there. So been in public accounting for 8 years, and then had my own. When I jumped out into internal audit work for several public companies, started to kind of start my own tax business. So had that for roughly about 6 years now, and been a CPA myself for over 8 years. But I was always kind of helping people, like ever since I've been out of college, and just directing people a certain way. Ironically enough, like my partner Terry Conyers is the one that got me interested. Partner for PC Financials that got me interested in real estate. To do it myself. Like
Right.
it was always recommended to my clients. I always knew the benefits from a tax perspective, but I just had this limiting mindset of me doing it myself. So roughly about 5 years ago, he literally like just put a property on my lap. Like, you know, these numbers work. Like, go ahead and do it.
Right.
So a little 3-2 single family townhouse, FHA loan. So basically 3% down on that. So I still have it to this day.
Nice.
Cash flowing about $300 a month. And it's just kind of a testament of like once it kind of clicked that I can actually do this stuff, it was like, okay, get into the flips and lease options and all the other creative financing aspect of things, building business credit from that standpoint. So kind of figure out like, okay, flipping really wasn't in my cup of tea. I'm more into the cash flow and the buy and hold, and especially with the tax benefits from there. And then roughly in late 2018, early 2019, started really focusing on multifamily because I wanted to scale up quicker.
Right.
From that standpoint there, but still kind of duplexes, quads, kind of thinking small from that standpoint, not knowing that there was such a bigger options out there until probably about mid 2019 when I came across Michael Blanc, and just kind of heard his story about being able to jump straight into like large multifamily apartment
Right.
buildings without kind of that school mentality of kind of
Yeah.
a linear approach. Like, no, you can shoot straight up. You just educate yourself in the front end. So, I mean, 2019 still went pretty well. Like, acquired 10 doors between duplexes and quads, and then started to try to hit heavy um, with the larger multifamily, connecting with the Garrett's and Gilberts of the world, the Brian Chavises of the world, and just kind of learning from them
Yeah.
uh, along the way there.
Well, let me pause you for a second before we go into that, because I really want to touch on, when you first got that first property, a lot of people, they're right there now. They're like, man, I keep hearing about how good real estate is, but it's the fear of, well, what if I do something wrong? Or it's the fear of, what if this doesn't work out? What if I lose my money? I could just put it in the stock market and a mutual fund. Like, so talk on that for a minute, man. Like, how did you overcome that fear of, doing that first deal? I know it was like a townhome or something like that. But how did you overcome that mindset of, man, I just need to do it? Like, how did you do it, man?
Um, I think just the team around me, like I said, it helped having a partner I mean, he's now a Class A contractor to kind of like help guide me along that way.
Yeah.
Uh, and then just seeing like the numbers work if this operates in this sort of way. Like we went Section 8 with it, so that guarantee income there. And then I mean, even from the aspect of just kind of bringing the property manager, because like I said, I still having a full time job and trying to build the tax business and
Right.
growing a family. It was like, okay, I can't really do all these things. So it was like I'm more of a team person anyway. So I typically like to surround myself with people that can help support the areas that I'm weak at, so I can focus on my
Right.
strengths. So that helped along the way there. Plus it being in my like literally 5-10 minutes where I lived at, so I could go around there and check up on it, and it's like, okay, I can start to see the vision now. Like it was there, just kind of blurry, but
Yeah.
uh, also like I said, the stock market, which like I said, you can get wealthy off of it. It's like I said, it just makes less sense for me. Like it doesn't really click for me. And like I say, if I'm going to put like my money into something, I would much rather, if I'm going to go to stock market, I'm gonna have to go through a broker anyway, instead of kind of
Right.
like
Right.
I'm much rather inclined to learn real estate because of how I can like it's a tangible asset that I can put my hands on, and from a buy and hold perspective, like I said,
Yeah.
the tax benefits and combined with leverage,
Yeah.
like is kind of it's hard to beat at that point.
Right. Right. Now, you mentioned something that I know some people was like, man, you just lost me there. You said you had a Section 8 tenant that you put in there. Let's talk about the pros and cons of that, man, because I know you weighed them out. You got the count in mind, so I know you looked at all of the good and the bad with it. So, what was it about going that route that made the most sense for you?
Literally, they were paying $200 more than what the market was, so it kind of made sense from that standpoint there.
Mm-hmm.
The annoying part is that it's like to get the property. There's rent ready, and then there's Section 8.
Right.
I think from like one story was like there was a chip on the back of the toilet,
Right.
like not like, and you would have to like lean over and look at it to see, and the
Right.
inspector saw it and failed us off of that.
Yeah.
I was like, "Are you serious? Off of a chip on the toilet?
Oh
Like
my
this
goodness.
person can reach back there and cut themselves?" And they gave all this whatever, man. We'll just and it, like luckily it was just the top piece, so we just replaced
Right. Right.
from that standpoint there. So I mean, didn't really knew about that like those little annoyances with the inspections until we actually got into it. But the
Right.
numbers
Right.
wise, it just made the most sense. Plus, there's this misconception of, okay, Section 8 people on Section 8 ruin properties and
Tear
all
your
of
stuff
that.
up. Yeah.
And it's like I went to high school. I know so many people that grew up on Section 8, and like they're some of the best people I know.
Right.
And I know people who aren't on Section 8, and they destroy their landlord's property. So it's like,
Right.
why does Section 8 get the bad rap that
Yeah.
it does, or from that standpoint. So like I said, so that part didn't really concern me at all. It was just, I mean,
Yeah.
it was guaranteed rents, and doing the service for the city and for my community, and
Yep.
they paid more, so it was all wins across the board there.
Right, for sure, for sure. And I'm doing property management here in Greenville, and I got a couple of tenants that's Section 8, and man, I get that check every month. I don't ever get any complaints out of them, so I really don't have a problem with Section 8. I really don't, man. As long as they don't tear my investor stuff up, we good to go. So let me ask you another question. Then you said on this property you were cash flowing about $300 a month. So my question is, why didn't you say, okay, man, if I can get 10 of these, I'd be cash flowing $3,000 a month now, or did you do that?
And that was the thought process, and it's funny. I had that conversation with my wife about a week ago, just kind of just reflecting back on where we
Yeah,
were. Goal back then was a property a year, like one door a year.
right,
I think there was a guy that wrote a book about one rental at a time.
right.
Got his name at the moment right now. Notice he got a purple book as well.
Yep,
but
yep, yep.
but like it was just kind of like just that small mentality. Okay, I'm just going to just kind of stack these up. But then just the effort that kind of took it, and on top of, okay, what do I need to replace my W-2 income,
Right,
along with how many clients do I have to bring in from a tax perspective.
right,
And then it's like, okay, does it really make sense to do just one door, like one rental property a year, and just kind of just stack these up, as well? And then you get caught up, and you're just in a more competitive. I mean, all the markets are competitive, and whatever level of property you go to is competitive as well. But um, as I'm kind of still building out these teams, these numbers don't make sense. Okay, I have to
yeah,
now finance out this FHA loan so I can do this whole thing again, or I got to put down 25%. So it's
right,
like, okay, this particular route's not making sense anymore.
yeah,
And then listening to a Michael Blanc podcast, and it was like, and I honestly do not sure how I even came across it.
yeah.
It just kind of popped up. I guess Google was reading my mind at the time. Right away. Yeah,
Yeah,
it's like, this makes all the sense in the world, and then you start to learn about others like the Rob Khalifs and the Brian Javises, and he's like, okay, I can work with this here, and this
right,
makes sense. I can build the right team around me, and we can all like grow something bigger. And then it's like it's actually something that could be changing for communities
right.
as well. So that's why I kind of decided to go down that route and step into multifamily.
Yeah, yeah. No, that's great, man. So let's transition into the multifamily side of this. When you're looking at stuff, what are you looking for? Like what does your ideal property look like as far as unit count? City, like what do you look for there, man?
The ironic thing is that me in my position, like I can kind of like be basically a placeholder for different investment groups. So
Yeah,
I'm in investment groups. They're looking at 2 to 20 units. I'm in like Rize is I mean we're got 120 on the contract, but that 20 to 80 unit where it may be mom and pops as well, and also part investment groups where it's 100 and above. And
right,
typically I try to follow the 1.3% rule, which basically is the market rents are 1%, 1.3% of the purchase price of the property, and or I'll go off of the typically 70,000 a door, uh, or yeah, per door at that point. Like
yeah,
that makes sense because of, especially now with how everything is so inflated, and
right.
rents aren't really going up in that same aspect. So I
Yeah.
typically assess from those two standpoints there.
Yeah. So 70 a door, and that's really just kind of depending on the city that is in, because if you're
Yes.
in a place like Raleigh, man, you're looking at around 130, 140, 150 a door, depending on the sub market that it's in, right?
Yep.
So it's really market specific on that. What you mean?
Yeah, and then because typically those rental rates correlate with
Yeah.
it like one something the door, or 100. When I say 70,000 a door from
Right.
that standpoint, so like if the rents can can't support 100 and something in the door, then okay,
Right.
it kind of backs into the
Yeah.
that 1.3% rule. Then it's like, okay, we can at least go with an LOI, submit that, and then let the due diligence make more sense of the numbers.
Yeah, yeah. No, that's really a good way to look at it, especially if you're trying to look at 100 properties in a month. If you want to narrow it down and really see which ones you can really focus on and dig deep on. So now that's a really, really good rule of thumb there. All right, man. So let's talk about what you do at PC Financial Services and what kind of value it adds to investors, because there are investors listening to this podcast, and I really want to learn more about what it is you do for investors and how it makes sense for us to work with you.
Yeah, we do more like tax consulting for professionals in real estate. As I guess we're all kind of come up in real estate, we try to find ways to add value. And I tell people I have this bit of like love hate relationship with being a CPA,
Yeah,
because I never really saw a purpose of it other than it got me uh, jobs in different like high paying jobs, and it's like, but
right.
that's not what truly values me. But now I'm starting to see there's value in it too. It's like, okay, I can understand the tax law in a certain way because I typically focus on that,
Yeah,
and from there it's like, okay, whether we do a cost tag study, or if you want a 1031, or does it make sense to invest out of your retirement account from that standpoint there. So I try to work with investors from a passive perspective who try to remain that way. Also try to work with many active investors as well,
yeah,
where you can kind of have a go-to source of not just underwriting, but okay, we can do that. We can do the tax strategy on the front end, and
yeah,
then the accounting on the back end, the bookkeeping and whatnot there. So
yeah,
that's typically how we try to support investors from different rounds. Just okay, let's just take their situation, get an understanding of them as a person,
yeah,
understanding as their team as a whole, because your tax picture is more than just your property. Like
yeah,
you got goals, you got aspirations, and like getting an understanding of that, and then aligning that to, if you're going to invest in real estate, here's what you can do to help get closer towards your life goals from that standpoint there.
yeah. Now you mentioned some stuff that most investors know about, but they're for the ones that's listening to this for maybe the first time, and you said a cost seg studies and 1031s that might have just flew right over their head. So man, if you could just kind of break that down on what that is and why is that important to an investor.
Yeah, so a 1031 exchange is just is deferral of capital gains tax. So if you have a rental property and you want to uh, access the equity in the property, I mean, you could get a do a tax free refinance cash out and put the money out that way.
Yeah,
Or if you want to, okay, you got this quad, you're done with smaller, you want to move up, you can basically sell that property and then roll those gains into a larger property, and it's called a like kind exchange from that standpoint there. So you end up basically deferring those taxes, those capital gain taxes down the road. And not to get too morbid, but like some people do a swap till you drop, and where you just keep 1031
yeah,
till you pass, and then your children gets the benefit of step up basis of now being able to, if they sell the property, they're not selling it from the original value, they're selling it as of the day that of your passing. So, but that's kind of
yeah,
very in
yeah,
detail there.
yeah,
Uh, that's kind of the basis of 1031. You're basically deferring the gains onto the next property, and moving forward from there.
yeah,
Cost segregation, how I like to explain it, is that if you buy a property for $100,000, just throwing out simple
yeah,
numbers, like that cost includes, okay, not just items attached to the building. There's a personal property items in there as well, and there's also land improvements, and there's also land as well.
yeah,
Cost say the engineers go in, they basically separate those items into what they are individually, and then you can say, okay, that's a personal property item. Like those appliances only should be depreciating over 5 years. not 27 and a half years like your typical building is. So people
Right.
usually would just take the building and then break out the land portion and then dump that whole amount into their fixed assets. And then
Yeah.
you're taking all of that and depreciating over 27 and a half years. But there's opportunities to depreciate and get a larger depreciation sooner if you have things in its appropriate buckets. And then, so the cost seg allows today, it also allows to maximize the 2017 Tax Cuts and Jobs Act benefit of 100% bonus depreciation for anything that depreciates less than 5 years or less than 20 years.
Yeah.
So it helps with that aspect of when you take that building, break it out into its appropriate cost buckets, actually segregating those costs,
Yeah.
and then maximizing the tax laws in the realm of okay, which accelerating depreciation and possibly bonus depreciation as well.
Yeah. Now I can give you two examples here, but two scenarios, and then you kind of tell me how it will play out. Let's say you got investor A, and it sounds like a one of the exam questions on the test. But let's say you got an investor A, and he's investing in his property, and a couple of properties, right? And um, his net income to him at the end of the year is $1 million, right? And of these properties, he did bonus, appreciation. They call seg study on it, and it came up to about 800, 900,000. Let's say $900,000. So in that example, would he be able to take that $1 million and subtract out the $900,000 and depreciation expenses? So his taxable amount is only $100,000 at that point. Is that the right way to look at that?
Yeah, so if the property nets like his net operating income is $1 million,
Yeah.
so all your depreciation is going to be below NOI. So it's going to drive down that net operating income less the depreciation. So if it's $1 million NOI and then depreciation comes out to 900,000, then yes, it drops it all the way down to just 100,000. So you typically could have made 100,000 operating the property well, and
Yeah.
then only pay taxes on $100,000 of it.
Yeah. Yeah. No, that's crazy, man.
Yeah.
Okay, so that's as the general partner, the guy that just brought the deal. How does this play into effect if you're the passive investor in the deal? Like you put up, 100 grand, 200 grand. Like how does that benefit us as passive investors?
So as passive investors, you're going to get distributions quarterly, monthly, annually, depending on what your syndicator, your GP wants to allocate that from as. So you'll get those distributions throughout the year. You're going to like what you're going to end up being taxed on is that the business itself is going to issue out a K1
Yeah.
per se. So there's going to be an equity split paid out, and then that same example of we had $100,000 NOI, but we had $900,000 in depreciation. That $100,000 now going to be split amongst all the GPs and investors on your K1. So it's most likely going to be a 1065 partnership tax return
Yeah.
that's going to be filed, and the K1 is going to be issued to all the LPs and the GPs. So you could possibly be taxed on less than what you've been actually be distributed throughout the year. From that standpoint, there, or quite possibly not taxed at all, depending on if the depreciation actually brings it down to a taxable loss, and
Yeah.
that loss is allocated throughout all the LPs and GPs as well.
Right, right, right. Okay, now just throwing another, random example at you. All right, so the back to the $1 million NOI, but depreciation comes up to 1.1 million. So now we're showing a loss. Are we now talk about how do you let's say somebody, making solid money on their W-2 job, can this money count against that income from their W-2 or what? Like, give me the rundown on that.
And I know everybody hates to hear this, but it depends.
Yeah. Yeah.
Because every so let's just hypothetically say I had that 100,000 and 100,000 loss,
Yeah.
10,000 losses allocated to that LP. Now, if their W-2, if their adjusted gross income is less than 100,000, then yes, like they have up to $25,000 they could net up against their W-2 income.
Yeah.
Uh, once it hits 100,000, then it starts that benefit starts to phase down to so every $2 above or every dollar above actually $2 above 100,000, that $25,000 phases down $1. So by the time you get to 150,000,
Yeah.
that benefit is no longer there. So
Right.
what ends up happening is people try to qualify for something called real estate professional status,
Yeah.
and that's kind of been the hot term for the past few years now.
Yeah.
Because like I say, it's a great benefit, but it's very tough to pass because in a roundabout way, you have to be a real estate professional.
Yeah.
Being a LP on a syndication does not mean you're a real estate professional.
Right.
So like those passive losses aren't don't just go away; they're just suspended and then roll forward into future years, waiting on passive gains to offset against. So if you're over 150,000, you're going to see a limitation of, or you're not going to see any of your losses bounce up against your W-2 or self-employment income unless you qualify for that status. Which there's
Yeah.
two criteria, one being 750 plus working hours and half of your working time in a real property trade or business,
Mm-hmm.
and then you're materially participating in your own rental portfolio. And being an LP in the syndication doesn't qualify you for that because
Right.
you're not making any management decisions that affect day-to-day operations. So,
Yeah.
as I recommend for a lot of my clients who are trying to reach that and they're primary LPs, is like, I mean, if you buy a small property, that can get you in on the right path. So because you have your own portfolio
Yeah.
from that standpoint, there, the how and then how it may affect that one LP depends on, okay, or if they're single, then it's very hard because if they got a full time job, how
Yeah.
can you say that you work half your time in real estate and you got this full time job?
Right.
Not
Right.
saying
Right.
it's impossible, it's just not credible.
Yeah.
And
Yeah.
you're
Yeah.
not trying to convince me, you're trying to convince the IRS and the tax courts
Right.
from that
Right.
standpoint there. But if that person is married and
Mm-hmm.
their spouse is not working, the spouse can qualify for real estate professional status, and then both of them can actually contribute that time requirement to material participation in their portfolio. So
Yeah.
it becomes a bit easier for those that are married and the spouse is not working.
Yeah.
Even for someone who's single, who's self-employed, and okay, can they adjust their role and their hours in their business to
Yeah.
say I'm only working 10 hours a week on my business, and but I'm actually working 30 hours a week or even more on my real estate business. So it
Yeah.
becomes facts and circumstances and case by case scenarios. That's why it's just easier to say it depends.
Yeah. 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 No. No. I completely understand the reason for that now. So as a realtor, I'm a realtor, and if I'm investing in deals, from an LP perspective, and my wife has a W-2 job, we technically can use my 700 because I can qualify as a real estate professional since all of my time goes into real estate as producing income, right? Would that be true or no?
It's a start because you're saying that you have a, even though you're a realtor, you have a, you may have your own business, but like your broker is not paying Willie Smith, is paying Willie Smith real estate agency,
Yeah.
so that you have a real property trade or business that you materially participate in, from that standpoint there. So like you are on the right track to that, and then once you have your own portfolio and your
Yeah.
own rental properties, then you can cover that as well because you're most likely showing your own properties. You're probably involved with the lease review as well, and kind of maximizing those hours there.
Yeah.
Then your wife, even though she's working, she may be involved with the property, and her time is also added to that as well. So
Yeah.
like you're in a position of not gaming the system, but like making sure you have the right documentation in place to
Right.
prove that one, you got the both criteria in place from a real property trader business as well as material participation on your
Yeah.
own property.
Yeah. No, that's I know people listen to this podcast like, man, what the heck they talking about now? But look, that's why it's a recording. Just go back and listen to it again. But there's some good stuff in here, man. I mean, it's to save you hundreds of thousands of dollars, if not millions. So
Yeah.
it's good stuff, man. It's good stuff. That's how people like Donald Trump, You know, they mad at him for not paying any taxes, but he's just using the system according to how it's written. So don't be mad at the player, be mad at the game, right?
Exactly. I mean, if like I say, if he was doing something illegal with his taxes, and as much as the IRS cracks down on tax evasion, like he would have been down already.
Right,
But
right.
like he has a team of professionals that deals with that for him, and that's their sole job is to like he doesn't. I mean, whether he understands it fully or not doesn't matter. Like he has the team that does, and he uh, pays them to do that and just work the tax code and seeing how he can benefit from there.
Yeah, for sure, for sure. Okay, man. Now we're about to get ready to transition to the last segment of the show, the lightning round. But before we do that, just real quickly again, PC Financial Services. When should someone reach out to you?
They can reach out to me, even though we're in tax season. They can reach out to me now. Like I said, I've found throwing my information out there. 757-535-8592 is my cell. It's constantly going off, and like I said, I'm always just eager to meet other professionals in real estate and add value where I can. Because the ironic part is like everybody that I talk to is potentially a partner, potentially an investor.
Yeah,
So even if I don't work with you from a tax service perspective,
right.
maybe work on the deal together and build from there. So I try to keep all those options open and keep my phone line open.
Right. For sure, for sure. All right, man. So what's the best advice you ever been given?
um, there's a book out called Who Not How. I forgot the author's name, but
Mm,
the advice is premise of if your goal is can be achieved by yourself, then your goals are too small,
mm.
and you need to bring the right people around you. The whole aspect of like get the right people on the bus and then find the right seats for them. So
Yeah,
it's a kind of extenuation of that where it's like okay, you need something done, you're not good at it, or you're procrastinating on it because it doesn't really bring you value. That person is great at it. Bring that person in, take it off your plate, relieve your mind, so you can
right.
focus on what you do best.
Right. Now that's good stuff, man. I like that. If you can achieve your goals by yourself, then you're thinking too small. I'm putting that on the wall, man. I like
Yeah.
that.
I got that stitch in my brain. Like I think I say it to myself every day now.
Yeah, for sure, man. What are some rituals that you've created that's made you a better investor or person in general?
The Miracle Morning has been huge for me. Just taking that time to meditate, work out, read, or listen to audiobooks and podcasts in the morning. Just taking an hour or 2 hours before the rest of the family gets up to take care of myself and like
Yeah,
basically like build myself up, get myself ready for the day instead of responding to the day. Like
yeah,
stuff up where I'm actually like bringing that action to the day and being ready for anything that comes.
right. No, that's good stuff, man. What is one thing you're focusing on right now to help you improve your business?
One thing, yeah. Um, so better communication, and with my clients from okay how like because I tend to be more personable with people
Yeah,
and how to be more effective in those calls where it's like okay like we're shooting the breeze whatever but let's kind of get to the point we only got 30
right.
and then kind of build from there so just kind of keeping that personality uh keeping that relationship and like
Yeah,
focus but being more effective with the time that we have so like I can get to the next
right.
rush somebody off the phone but just kind of be
Yeah.
efficient in the next meeting.
Gotcha. If you can give your younger self one tip in regards to investing, what would that be?
Use your FHA to buy a fourplex.
No, that's great advice, man. I tell everybody, like especially all the young cats that be talking to me about getting in real estate, man. I say, look, dude, go buy a freaking fourplex and use the FHA loan. You only got to put down 3.5%. Move in one side for 1 year. After a year, you move out, rent it out, and go do it again. Like, dude,
Yeah.
boy, I swear I wish I could do it now, but I got too many kids now to make that happen.
don't think the missus will appreciate fourplex with two boys. So it's like
Yeah.
that train is gone.
Yeah. That man, that thing left a long time ago for me. All right, man. Last question for you. What's the worst job you ever had?
Wow, the worst job I ever had. That's a good question. Being,
Yeah.
well, it's not really the worst. It's basically ends up being basically the worst people that I end up working with. So there was one where I was an internal audit for a bank, and then I mean I think that's really when I started kind of. I think what ended up happening was I started kind of getting like reading more into like Robert Kiyosaki and Rich Dad Poor Dad, and then
Yeah.
like my mind just shifted, and then like everybody got annoying to me at work. So it wasn't the job fault. It was
Yeah.
just like I'm just seeing the world differently now, and it's like
Yeah.
I had to start making a plan to get out because this doesn't make sense anymore. Like
Yeah.
I'll be doing this for another 30 years, and and be probably in a worse situation than I am, like depending on where Social Security is and all of that.
Right.
So I think it was just the premise of just having a job in general. Like I've learned a lot, and I'm grateful for those lessons that I kind of bring that into my business and the friendships I made. But like I think just having a job in particular that's not building up for my family was just not going to work for me anymore at that point.
Yeah. No, that's that makes a lot of sense, man. You know, everybody that read that book, you know, they come away with different things, but that's one of the things that really stuck out to me, man, is, you know, getting out in the rat race, man, and doing your own thing and trying to grow your own wealth. You know, that's key, man. But yeah, man, we're at the end of the podcast here. You know, appreciate you coming on, sharing your wisdom, sharing your knowledge. You know, how can my listeners, if they want to reach out to you, do you have social media, website? Where can they get you at, man?
Yes, I'm on Facebook. I'm on Instagram. I'm on LinkedIn. There's just Larry Pendleton CPA. So I try to make myself easy to find. From that standpoint, like I said, I'll throw my number out there again: 757-535-8592. Like I said, and then I'm not sure if you want to put in the show notes. I have a link app, LINQ, where it's
Yeah,
just basically my digital business card, and people can see other podcasts that I spoke on. They can get my emails and my number there as well, and reach out to me that way.
yeah,
And looking forward to adding value where I can.
absolutely, man. We appreciate you coming on today.
Hey, thank you, really appreciate it. This has been awesome.
Yep.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.